This is the K-State Radio Network and Agriculture Today. Thanks for tuning in once more. First off, to the grain markets. What's going on there? Dan O'Brien is aboard, grain market economist, K-State Research and Extension, for his weekly visit about these trades. As we go along here, Dan, we will get into what you've just posted online at agmanager.info, your latest price probability projections for corn and soybeans. Interesting numbers there. But to the trading week just passed, seems that across the board, the markets are fixed on, well, two things: South American weather and the ongoing tensions on the Russia-Ukraine border. Is that how you see it?
Well, yes. And varying reports about the Russia-Ukraine issue. And that in particular is a factor in the wheat market, probably the primary supporting issue in the wheat market, along with dry weather that we've had here in the U.S. And there were reports earlier in the week that troops were being taken away from the border, but this happened to be by Russia. But then U.S. State Department spokesman came out today and said no, and NATO also that no, tensions are, there's just as much potential as there was before. So again, we're not into the politics of all that, or we shouldn't be, other than to note that that uncertainty certainly is a factor up and down in the markets. We have a lot of volatility just on a day trading basis. You'll look at what's happening in the morning, up 30 cents. By the time a rumor gets shot down, it's down 25 or 30. It's kind of an issue, quoting an old poem from someplace: if you can just keep your head and all about you are losing yours, you'll do well, or you'll stand firm, basically is what's implying. So in the wheat market, so in the wheat markets, yes, closed yesterday in March at 823. Very little carry, just 1 or 2 cents going forward. Generally up 15 some cents, but we've been up and down, generally moving a little bit to the high side. You can see on some of the charts that we show on our daily notes and summaries. So quite the situation. And when you follow on wheat, since we're talking on that, we have okay exports, but again, what's the support for the wheat markets coming from the potential of what could happen. Actual wheat exports for all U.S. wheat for the week ending February the 10th are about just a little over 15 million bushels. We need a pace of about 21, 22 to meet the USDA's projections. So anyway, and also for hard red winter wheat, a pace of about 6.7 million bushels, need about 9 to meet the USDA's projections. And if anything, more disappointment than in other markets in terms of where the hard red spring wheat market is at. Exports are about 3 million bushels for the week ending February the 10th, and need a pace of just about 5 to meet the USDA's projections. So what's the USDA up to? Well, they're, on those projections, they're betting on the future that if a conflict comes about in the Black Sea region, that there'd be at least disruption of logistics in moving wheat out of there. If not, flat out repercussions on whether trade could go forward between Russia and these other places. So you'd have two countries, to arguably the two price leading countries in the world wheat markets in military conflict, and the potential for a lot of problems to occur.
No doubt. As for the feed grain and soybean trades, it is about whether or not it'll rain in South America. And for the bulk of the week, the answer to that has been no, and prompting higher prices.
Yes, some forecasts of a little bit of moisture in the interim, but then a return back to warmer, hotter weather in weeks and days and weeks following that. So again, we closed on yesterday at $6.50 for the March contract. Just amazing. We're just taking that in stride now, not even blinking. $6.50 for March 2022. New crop at $5.96.5, heading for $6. And remember also that this is a time for corn during the month of February when we're looking at that D's contract and our pardon me, and are figuring out our crop insurance planning price for the 2022 crop that will be harvested. Same situation is happening in soybeans, 1460 as of yesterday's close, so well above $14 for that USDA average. But by the way, the corn average last I looked was about 487, 483, something like that. Higher closes like this halfway through the month could lead that just that much higher. So anyway, but for soybeans, 14 and a half, $15, something like that for a planting price. And all that's positive for both those crops in terms of encouraging planting. I would say that the upfront contract, March contract closed at 1592. And when you look at recent history, we've closed over $16, a fair amount of, in the last several days, or at least traded over that. So a lot of support for where these markets could be going in the futures. And I think the main scenarios that I've been wondering about, for the one thing we can two things we can sort of look towards would be, what our acreages might be for corn and for soybeans, and also how some of the inflation in costs, lack of availability of fertilizer and some of these other inputs, how that could at least have a modest or a moderate effect on corn and soybean yields this year.
And those, in fact, are the main ingredients in the aforementioned price probability projections that you have put together for corn and beans, acreage expectations, possible production complications. Let's start with corn and what you're thinking along that line.
Well, keeping in mind that this year's season average price is projected by the USDA to be $5.45, with about 10.4% stocks to use. If we look at three scenarios, say about a 20% chance of corn acres being unchanged, corn and soybean acres being unchanged this year, that farmers heroically planted all the corn that they intended to, and then none of that bled over into soybeans. And again, putting about a 1 in 5 chance that happens. So I'm not really believing that's going to happen, but a 1 in 5 chance that it would. Then you end up with and assuming, about a 2 bushel per acre U.S. average yield loss from 177 down to 175, just because of fertilizer issues. If nothing else, just that, much less dry weather showing up all over the place. In Western Corn Belt anyway. So you've got a size of a crop at 175 bushels an acre, about 14.9 billion bushels. Ending stocks about 1.6, 1.7, 11.3 stocks to use, and a price of about $5 for the season average price. So that compares to 545 this year. Now the next scenario for corn, it would be about a 1 million acre loss from the previous year. Again, 175 bushels per acre, and crop size of about 14.8 billion bushels, 1.5 billion ending stocks, and about a 10.2% stocks to use. So just not far off, just a little bit lower than this year. So about a 560 price. And I'm saying there's about a 65% chance of that, almost 2/3 chance that we end up with some reduction in corn, some increase in soybeans. And then the tougher scenario, if you're a corn buyer anyway, about a 15% chance of us getting about a 2.5 million acre reduction in corn. That all goes to beans. Again, saying that's about a 15% chance in my own judgment. You end up with a U.S. corn crop at 175 bushels an acre of about 14.5 billion. Ending stocks 1.7, 1.2, 1.3, and prices at 675. We're in that price stocks to use situation to where we'd be getting tight and prices start to really respond. So you just flip that scenario and go over to soybeans and see the other side of that. Again, 20% chance of the same planted acres and about 50.5 bushels per acre instead of the 51.4 we had this year. You got at least a modest decline, about 8.95% stocks to use out of that, 388 million ending stocks, about 4.36 size of crop. A price scenario of about $12 a bushel. And I'm kind of have trepidation in talking about these other scenarios, because after looking at $16 soybeans, when you hear a very conservative price forecast for the next year, people are likely to shake their heads in disbelief. But when you look at where we've been at, unless you're counting on inflation to save the day on prices, and you look at where we've been in the past year or so, even this past year, the USDA projecting $13 a bushel, then you end up with a 1 million acre more scenario, and the 2.5 million acre more scenarios giving you about 11 and a quarter or 10.75. So all these prices that we have now, if these scenarios play out, the new crop bids that we're seeing in Kansas at different places, and some of them are substantial. When you look at new crop soybean bids of 1361, 1406, 1391, those new crop bids are substantially higher than, at least by my calculations, we'd end up if we actually plant more soybeans, we have a decent crop, and we have to absorb increased supplies in the market. So thought-provoking, not trying to just be a negative bell ringer, but there's some risk out there in soybean market if we actually see sizable acreage increases and some of these other issues that are coming in and affecting all of the world economy and ag commodities.
And again, those projections are spelled out fully in Dan's weekly notes at agmanager.info. Before we let you go, Dan, you mentioned local bids, forward contracting opportunities for soybeans, but more widely, you are keeping a close eye on those local spot cash and forward contracting bid relationships at the delivery points around Kansas.
You really see the new crop bids for corn in the Garden City, Southwest Kansas area standing out. On yesterday's closes, $6.17 is the new crop bid for corn in the Garden City market, and that there's nothing else really above five. Well, there's one at 586 in Hutchinson, 581 in Colby. So you've got about a 25 cent gain for corn in Garden City over anywhere else. So again, feedlots, some ethanol plants, dry area, that's what you get. For grain sorghum, you have some pretty strong bids in Colby and Salina and Topeka, and weaker bids in other places. So some of these are export-oriented markets, and you really see those standing out, in particular the Salina and Topeka markets. And you've got some pretty strong bids, over $14 in Salina, Topeka, and Hutchinson for soybeans, and some weaker bids elsewhere. So again, processing not that far away from some of those locations, as well as export possibilities. One thing that really stands out also in the wheat market is in the Hutchinson area. Maybe it's just one wildcat bid somewhere, but one bid in the Hutchinson area at some of one of the terminals at $8.28, at least as I saw it on looking at the source I was looking at, happened to be DTN. So strong bid. And of course, for wheat, when you have that bid at 828 and everything else at about 799 at the best at these other major terminals, somebody's probably looking to fulfill some export commitments or something like that. And we tend to see that in South Central Kansas. You'll see a bid jump up every once in a while, and then next week it goes away, or next day or so somebody's got some type of commitment they're filling.
Yeah. Interesting dynamics at the local level for sure. And by the way, we'd mentioned that the USDA will be posting new numbers in its annual outlook forum later next week. We'll pick up on some of that when we visit again, Dan. Until next Friday, many thanks to you.
Thanks, Eric. Take care.
Along with us each Friday is Dan O'Brien, grain market economist, K-State Research and Extension. And once more, be sure to tap into his weekly notes on the grain trades, covering everything and more that we discussed right here. Agmanager.info is where you'll find those. We'll be back on Agriculture Today.